All right, whole fiscal cliff Senate Democratic vote story developing in Washington tonight. So let's get the very latest from our pal Eamon Javers at Capitol Hill. Eamon, what's cooking?
Good evening, Larry. Well, we're told that they're expecting to go very, very late tonight, possibly later than midnight. And just a couple of quick points here on that. In just about 4.5 hours from now, we trip over that magical point where they're no longer voting to increase taxes. They'll actually be voting for a tax cut because taxes will go up automatically at midnight. Politically, that could change some of the dynamic here. And then one interesting note on having these votes on New Year's Eve. Members of Congress, you know how they are, Larry. They were told by their leadership here on the House Republican side that they are to, for the rest of the night, remain in an accessible state, quote unquote. And I'm told that they were not talking about their physical location. They want these members to be prepared to possibly have to vote here later on this afternoon, or later on this evening, I should say, Larry.
Not to speak of their inebriation. I thought that's what you were talking about.
Well, that's exactly what I was talking about. I was trying to be a little delicate and coy, Larry, but you just went right there. So they were told to remain in an accessible state. And I think it's at some point, you know, they might have to send the MPs out to round them up to get them back here to vote
MPs,
later on tonight.
And my love, I got to say Happy New Year, you and everybody else. Me, I haven't had an inebriation in close to 18 years. God bless. Anyway,
and you're a better man for it. Congratulations.
Thank you. You're sweet. Let's move on. We've got to get some more expert commentary. Here is an update from an old friend and pair of ours, Robert Reich, is former Labor Secretary and CNBC contributor, author of Beyond Outrage, and Steve Moore, the Wall Street Journal editorial board, author of Return to Prosperity. I guess, Robert Reich, at least the tax thing's not going to hurt near as bad as I thought. But why is it your Democratic friends never want to cut spending, never want sequesters, never want entitlements, and never want to shrink the government? Why is that?
Well, I think a lot of Democrats are willing to cut military spending and get rid of a lot of corporate welfare and do a lot of things that maybe you would agree with, Larry. The problem with this bill, honestly, the biggest problem is it doesn't deal with the debt ceiling, which means that we're going to have trench warfare right through January and February and March. This is not going to end.
Steve Moore, Robert makes a good point. The debt ceiling, which is a very scary thing because it's Republicans' maybe last shot at leverage, but markets in the world and the credit raters get real nervous, as I do, when you start messing around with the U.S. credit worthiness.
Well, Republicans didn't want to give up that card, Larry, and it's precisely because during these negotiations, Democrats showed absolutely zero interest in cutting spending, and Republicans think that's the only card they have. I want to just say one thing about this deal. I mean, if you look at the specifics of the deal in terms of what might have been and what the president was holding out for originally, you know, it's not such a terrible thing. It's probably the best Republicans could get. But, Larry, I want to make this point loud and clear. This is not a pro-growth change in our tax system. This is raising taxes on investment, on businesses, on workers. I don't see anything good about it for the markets, except that we finally have some resolution of this. But raising tax rates, Robert Reich, is no way to grow the economy. And unfortunately, this has become the kind of creed of the left. I think they're reading your book too much because this is where the Democrats are now. Raise tax rates across the board.
Steve, you and I obviously disagree, and we might even disagree all the way through 2013 on this one. But Happy New Year to you anyway. Look,
too, sir.
The problem here, honestly, is that it's the middle class and the lower middle class. They're the ones who create jobs by their spending. And if you increase taxes on average working people and you make their burdens generally greater in whatever way, however you're going to do it, and you cut spending, which is very important. When you have high unemployment, you've got to have more government spending to create jobs. This is going to be a huge burden on them.
But I've never understood. Bob Reich, my friend, you're a good man. You know that, and I respect you. But I don't look. You're raising tax rate. It could have been worse. Steve Moore is a whole lot right. It could have been worse. But you're raising tax rates in this kind of bill, and more coming next year, according to the president's news conference today. You're jacking up tax rates on those most likely to invest in businesses and the economy and machinery and jobs. Why would you want to tax those who are most likely to invest? I don't get it.
Well, I'll tell you why, Larry, because there's something called the budget deficit. And you and I and Steve might not think it's a huge deal, and it's certainly not a huge deal right now, but it is going to be a huge deal, and somebody has got to fork over some money to deal with it, and also we've got to cut some spending and cut some public services. And the question is, on whom is the burden of that going to fall? Is it going to fall on people who are very wealthy, or is it going to fall on the middle class? And here is where the nubbins of where you and Steve and I part ways, because it seems to me that right now very wealthy people and big corporations are sitting on a lot of money. The problem is that they don't have the customers. Well, they don't have the incentive to actually invest that.
Let me ask you this question.
I'll give you the last word, Steve Moore.
Let me ask you this question.
Well, don't give him the last word. That means he gets the last word of 2012. The entire year, he gets the last word.
Something for you to ponder in 2013. What's the next act for liberal Democrats like you? I mean, you're going to get your pound of flesh out of rich people, but Larry, it's only going to raise at the best $50 billion. Robert Reich, that still leaves you with $1 trillion deficit. If we don't get serious about the spending side, then you're going to have to go after the middle class. And Larry, the president said as much today.
He did.
This is only the start of the tax
But I want to get this is the last word. Healthcare costs. We've got to deal with healthcare.
We just passed
Obamacare. You look at Grover Norquist's website. You look at every other website.
All the taxes and that.
Obamacare is going to raise taxes another $1 trillion in the next 10 years.
Healthcare is already up to 18% of our GDP,
and we can't
regardless of Obamacare.
Because of Obamacare.
All right, Obamacare. More tax.
Happy New Year,
gentlemen.
You tax
Happy
increase
New Year.
Happy New Year, everyone.
Steve Moore, good to see both of you. Thanks a million for helping us. Let's get back to the markets. Rejoining us now is London-based CNBC's Kelly Evans. She is the host of Worldwide Exchange. And let's bring in another brilliant investment voice. Lee Munson is the Chief Investment Officer of Portfolio LLC. He is the author of Rigged Money. I don't know. This may be a rigged deal, but Lee Munson, can I just assume that somehow we have to look past the cliff? The tax thing is going to be okay, all right? Not to my liking, but not as bad as I feared. And there won't be any spending cuts. There never are. Now, look, can I just put that aside? Thought experiment. Forget the cliff. Just tell me what to do in the market for 2013. Forget the cliff. Give me market wisdom.
Okay, well, Larry, I know that, you've always said the only thing you've ever held, over the past 10 years are spiders or, the S&P 500. That served you very well. You've made over 13% on that position this year. I'd say going into next year, number one, go with small cap, because if we are going to have any type of growth in this economy, which I hope that we have some, I think the small cap indexes in America, forget value, forget growth, stay with that. That's where the momentum is. If you want the contrarian underdog, go and invest in some emerging markets. And the place, Larry, that I need investors, if you're retired or close to it, avoid all these high dividend paying stocks because it's a crowded trade. There's way too much money. Stick with small cap, stick with the S&P 500. Don't get crazy.
All right, I'm in the S&P 500. I'm always in the S&P. He's more optimistic than you are, Kel.
Well, I think the question is long-term versus short-term. And I just want to sort of circle back on this point and talk about the first quarter a little bit. So we've seen stocks responding well to the concept that there will be some sort of deal on the fiscal cliff. It looks like that's still happening. But we haven't gotten over to the debt ceiling issue yet. And the more that I hear, Larry, on your show, on others throughout the day, the more I feel like this is going to be the site of another huge battle. And Lee, I wonder if you want exposure to the S&P, for example, between now and then.
Well, I do want exposure, and I'll tell you something. The biggest indicator that we can look at collectively, here and bring out to the viewers is look at the 10-year Treasury, look at the bond markets. If investors and sort of the global markets were that concerned about a debt ceiling, we wouldn't see rates this low. So I think you've got to follow where trillions of dollars are in.
But Lee, that's not exactly true, because what we're actually seeing are Treasury yields falling as a barometer of people getting more concerned about the debt ceiling. Because what we learned the last time around is it's not necessarily about a backup in yields because the government isn't going to pay. It's more about yields declining as people get concerned again about growth prospects. That seems like the most likely thing that could happen again here.
Can I just insert one newly emerging country no one mentions? All right, give Kudlow the last word on this. Japan. It is right now, Japan is arguably the hottest stock market in the world. And you know why? They are properly devaluing their excessive currency, the yen, and pouring in money and raising their inflation to get out of deflation.
Are you calling for fiscal and monetary stimulus? Because that's what Japan is doing.
Larry, who said that on your show 6 months ago and everybody yelled at me?
I absolutely think the new Japanese government is right. They need monetary stimulus. Their fiscal spending is all wrong. They should be lowering supply-side tax cuts. But on the yen, dropping the yen, right. Exports, imports, this is exactly what they should do.
14 trillion yen fiscal stimulus package is potentially coming. That's why the market is responding.
It's probably hurt more. I think that falling Japanese yen is so important. I'm just going to make this. What do I know? I'm just going to tell you that Japan is the most underrated story,
I'm saying
whatever
you're
the
right,
reason.
But for the same reasons, you should be calling for fiscal and monetary stimulus in the U.S.
Yeah, fiscal stimulus to me means low marginal tax rates, not Keynesian spending. But thank you to Kelly Evans and thank you to Lee Munson. Now, let's get a look at how things look from the Republican side. Oh, my goodness. We welcome back Congresswoman Nan Hayworth. She is about to join us, I guess, right after the break. I'm Larry Kudlow. Stay with us in Japan.